So for the objectives for this lecture, we're going to go over patterns for bearish and neutral setups, then discussing the tactics along that's relative to those patterns, and then closing up with the application and implications of how the chart pattern recognition applies to your trading practice. So here is a list of the bearish setups, and they're all basically going to follow the same pattern rules like we discussed in part 1 in terms of the pattern recognition. However, the main difference being that it's inverted. So for the descending triangle, it's going to be the same concepts as well. So you're going to look for a horizontal SAR along with a downward slope and minimal space in between the candles. So as you can see here. So in this example, we use, as you see here in the apex, it didn't exactly break down. So it may or may not be the case in most of the time, but usually when the price approaches in that area, it's projected to go far below. This one, in this chart, it did break up, but then eventually it did go down shortly after. This one doesn't constitute as a descending triangle because even though it has the horizontal SAR and the downward slope, there's too much empty space right here. It's really just a channel down. It's really just a channel downward. So some tactics and insights other than those two that I've mentioned, this one's like an important key point where as soon as like it reaches the apex, that's gonna be a crucial turning point on where the price will be headed. And also you can initiate a position at the SAR, but you just have to be quick when you sell the ride up. So usually the ideal way to do it is to buy at the support and then sell once it hits near the resistance line. So for flags and pennants, again, they must have the poles and generally shorter than 3 weeks. And also you definitely want to identify what the predominant trend is. When you identify the predominant trend, these flags or pennants almost or most of the time they revert back, and then before they do like continuation. So this one here is like a visualized forecast for what looks like to be a bear flag. So as you can see here, the predominant channel is downwards. So, and here's the temporary reversion that most flags or pennants go through, where it'll run up and then eventually like go off downwards. You also want to keep the price action of the candlesticks as close as together, so you get like the most price action that way. So for the rising wedge, what it is really, it's an upward triangle with the apex pointing up. So you're looking for two upsloping trend lines, and then you want to find the ones that touch both trend lines multiple times. There is the tendency to sharply like reverse shortly after, but not always the case, and it also may break out for continuation. So you see here, this one's like a classic textbook rising wedge with the two SARs and then a sharp reversion afterwards. Rising wedges do come in multiple names. They're also known as bearish wedges or wedge ups. So here, this one is rather subjective. So you're seeing these three trendline SARs right here, and they're all pointing upwards. So, and the price is near the apex. So here's the poll. Would you initiate a long or a short position? For those that answered number 2 of for going short, why go short? Well, 5 of you said short, 0 said to go long, only 1 said maybe. It is a rising wedge, but it's near the apex as well. And it's actually riding in the middle of the resistance line. However, what if I told you that there's an inverse head and shoulders near the apex? So did that change your mind? So for this case, which one will be like the prevailing pattern? Like, so when you see like multiple patterns in one, like a pattern within a pattern, you don't exactly know which one's gonna prevail. So this one, you're expecting a bearish reversal, but then again, that inverse head and shoulders, it might go up even more. So usually when you see these, what you would do is, now you see the trendline SARs, you're gonna mark up where the neckline and the other support resistance lines are. So since that price right there is like riding along the middle trend line, you can like initiate a long position there, but it is riskier, but a safer bet to initiate a long, and also in order to confirm that inverse head and shoulders, would be starting a position once it breaks above the very first trendline SAR. Would you also check out patterns within a smaller time frame? Yes, you actually would. That way you're able to weigh out the risk versus the benefit. So in general, like rising wedges don't last very long. There's almost always a very sharp reversal. And again, like the apex is the crucial turning point. So for double tops, it's going to be the same concepts and rules for double bottoms, except that it's going to be 2 peaks that rise at the same or nearly the same price. And it's going to be V or U-shaped, and there's going to be variations with the Adam and Adams and Adam and Eves and vice versa. A break below the SAR confirms the pattern. So here, like, you could see the double top. So if you look into like an aggregate level, you could if you cluster these and then cluster these, that's also a double top. Assuming we're going to be focusing on this one with this double top, you can see here you draw the trend line SAR here at the base, and again you're looking at the historical resistances, and then you see where they most frequently touch. So a break below this area confirmed the pattern. So if you were a bear, you would initiate a position at the trendline resistance right about here. Wait for it to confirm. So around this area would be like a conservative like position to enter. Then once you hit the trendline base, that's where you'll reevaluate your position on whether to cover or maintain your position. So, but in this case, it broke the support. Keep holding your position. Now that there's a new base, here's the area where you'll reevaluate your position. But if you're a bull, you generally like hold up on the baseline SAR, see where it goes, and then ride up the wave, and then reevaluate your position here at the resistance line. So for double tops, you're generally looking for like 2 parallel trendline SARs. So you're gonna find where the base and the resistance is. So for the triple top, it's gonna apply the same rules and concepts for double tops, except with the 3rd peak. and they're also generally going to be symmetrical. So in this example, you'll see that this is the approximate area for the baseline SAR, and here's the approximate area for the trend line resistance. A break above here confirms the pattern, but as you can see here, it did end up bouncing back up and then eventually falling short. But on an aggregate level, if you scale out, you can see that it's forming a cup, an inverted cup. And then this one is rather subjective. So you see that there's the trend line SARs right here, along with the base. So there's 3 peaks, but the third peak is starting to form. So should you initiate a long or a short position? So the majority of you answered short, since because it did hit the resistance line and it failed to break up, just as Lieutenant noted here. But what if I told you it looks like a bull flag? Oops. And the predominant price channel is actually, it seems like it's going upwards. Did that change your mind? Lieutenant stated, wouldn't it still need to come down to bounce off that support to continue the bull trend? Yes, that is actually true as well. Well, it will really depend. Let's say you're gonna wait and see if it holds at this support right here, and then but you're gonna evaluate and see where the price action is headed. But right here at this resistance line, you're gonna wanna, to ensure like the confirmation that it is like a bull flag, it'll have to break above that trendline SAR. I did Duffner 3. I didn't notice the bull flag because I thought it would be a sharp pull. Remember, for pulls and these types of flags or pennants, you're looking for a straight line run. So let me erase this thing over here. Sometimes it can get like a little bit confusing because then you get this noise right here. But if you visualize it like you're kind of zooming out even more, you'll see that it just goes in a linear fashion. Here's like a summary of the tactics and insights. You're definitely gonna watch for the trendline SARs for the base and their overhead resistance, and it could also turn into like a multiple top if it fails to break the resistance. So head and shoulders, it's gonna follow the same concept, same rules as triple tops, except with the middle peak being the highest. The pattern is generally symmetrical, but not always, and the neckline right here is the armpits of the pattern, which is usually like the valleys of the peaks. And if you cluster them together, that forms like a complex head and shoulders pattern. So in this example right here, this is like a classic textbook pattern. So you can see here's the neckline with the baseline SAR, the middle peak being the highest. As if it breaks below it, that confirms the pattern. In order to break that pattern, you'd want to evaluate if it's able to break the highest peak line resistance. Look for the ones with the neckline that has an upward slope, because in general they usually do break the pattern that way. So if you're like a bull, but if it's like a downward slope, it's ideal for a bear because then it has like a higher risk for confirming the pattern. So for inverse cup and handle, you'll be looking for an upside down U. And remember, with the handle having the least amount of retracement, as a rule of thumb, you want it to keep it less than 1/3 from the rim to the bowl. It is related to rounding tops, but rounding tops are generally 10% of the price action. So as you can see here, it's the classic inverted cup and handle where there's a linear curve. I'm sorry, a trend line curve. And here's the baseline SARS, and it's forming like the downward channel and confirming that pattern. And here these are like considered the lips of the pattern itself. So if you were a bear, you may take a position here, but you do have to be a little bit careful because it's in like a neutral like area. But the best way really is to confirm that the price breaks well below this trendline SAR. So here's ones that's complex or subjective, like cup and handle. So when you're looking from an aggregate level, you're seeing that it's a curved pattern, even though there's jagged edges on the top. And then you could see here that there's like a triple top as well, or a multiple top if you include this like little peak right here, and then some bull flags and then some bear flags. So here's one that's rather subjective. So here's the triple top, but with the curved pattern. So in here, if you're a bull, you may like initiate a position here, but for like a less riskier trade, you would initiate a position once it breaks above here, and then reevaluate along the way of the price action. And then if you're a bear, you would initiate a position here, but this area, as you can see, it's forming like a rectangle. So it's really more of like a neutral trade. You would initiate a position once it breaks above here, and then reevaluate along the way of the price action. And then if you're a bear, you would initiate a position here, but this area, as you can see, it's forming like a rectangle. So it's really more of like a neutral or setup. So for other patterns, these ones are not really quite as popular. So the inverted scallops, they are basically like upside down JR hook patterns. The three falling peaks, they're generally like lower highs and lower lows. And then sometimes like the easiest way to spot them is if you see bear flags forming, and that becomes like a downward staircase. And then rounding top, it's just a dinner plate like flipped. So for neutral setups, these are the three primary patterns we're looking at. So for diamonds, you're going to look for higher highs and lower lows on the left side, and lower highs and higher lows on the right side. So the easiest way to see that is if it makes like a megaphone pattern and then eventually a triangle pattern. and they don't necessarily have to be symmetrical. They can look like parallelograms as well. So here, for the ES future, there's a formation of the diamond pattern right here. So, and if you draw like the trend line SARs, they're around these areas. And you do have to be careful with these, with trading diamonds, is because they do have the tendency to form head and shoulders. So this one is rather subjective. So you're drawing out the base SARs and the resistances, and it does look like it is a diamond. Should you initiate a long or a short, or maybe? So some of you have stated long, one short, and one maybe. So, Lieutenant, wait for confirmation for the breakout of the diamond, then long. Yes, that actually would be like the best way to do it, because if you look at this pattern, yes, there is a diamond. However, there is like a cup and handle, or maybe a cup and handle. So you'd want to see like the price break above here to at least confirm the cup and handle. Or if it breaks down, that usually will confirm like a head and shoulders. Or if it just continues to hang around here, it'll eventually just become like a rectangle, which a rectangle in the sense that it's neutral. Rectangles, the price just bounces in a horizontal channel. And they generally are hard to find like in practice. So here's one from MTBC, which was like I think that was about a couple weeks ago. So you can see here the trendline SARs. Let's say if you bought around this area, and now the price is around here, what's the best action should you take when you got in early? Keep holding, buy more, or start managing risk? The best choice to do it would be like start managing risk, and you could do it in multiple types of ways, where you just scale out, or you're just reducing your position, or that you're just like quick, or like you're keenly observing it. What may look like weakness, you're just gonna close out your position completely. For a symmetrical triangle, they will be following the same rules as well. So you're gonna see converging trend lines. That's like in a 180 or nearly 180 degree, with the price action like filling most of the space. So for this one, there is the pole right here for the pennant, and you're identifying the predominant price trend. So the best way for you to initiate a position is the break above the apex. This one is also subjective. So the projected trend lines right here, it's nearly about to converge. So if you're quick enough, you can initiate a position here at the support and then sell at the resistance, and then wait for a decision at the break or breakdown of the apex. So the general concepts with neutral setups, the reason why I deem them as neutral is because like you're really playing with the 50-50 rule, where it's maybe gonna go up or maybe gonna go down. like Per Bulakowski, he labels them as like diamond tops or diamond bottoms based on where the predominant channel is. But really, because that since you can't predict the future, you don't know if it's truly the top or like truly the bottom. So I do generally avoid these types of setups, and I'll wait until it makes a decision. So here are the application of concepts. So earlier in the lecture we noted that chart patterns empowers you to see like the big picture. So you're gonna at least get an idea of the direction of the price, the trend, and then the time frame. And at the same time, you need to be like self-aware of the situations. What we've noted earlier with the neutral setups, you don't know if it's gonna go up or go down, since there's just really no way to predict the future. And also at the same time, there's really no way to forecast of whether or not it's gonna be a bull trap or a bear trap. Once you get like the idea of the picture itself, it leads you to like defining your objective in this, and then also your plan. Chart patterns is like a graphical representation of the price action. Like it really goes to back to seeing is believing. The proof is right in front of you. So what you're seeing in that chart and the price action, you get these thoughts where, are you going to trade what's in front of you, or should you even press the button? Because of what you're seeing as well, there's a very like heavy psychological involvement. So sometimes when you go in a trade, you're expecting it to be going your way, but it ends up being like a dumpster fire. Experience, sometimes you might end up like in an infinite loop where you're not confident in seeing what you're seeing, so you keep waiting out, or you keep having these negative results, but yet it'll also leave you to another stage where you're so unconfident that you keep second guessing the trades that you're doing. But really, when you're trading these chart patterns, it's really best to tailor it to your personality. So if you have a hard time sleeping at night with these low float stocks, it may be best for you to like stick with blue chips where the price moves slower. So in relation to the technical indicators, so on top of the chart patterns, you'll be using these as a guide to help you initiate or to close out a position, or to see at least if you will or won't take one. So we've noted throughout the lectures as well that the patterns will vary across in time, anywhere from minutes to several weeks. Since let's say you want to keep like a short-term objective, you're going to look at these technical indicators to guide you on whether or not to take the position. So a lot of new traders, like, they get confused with what time frame they should use. So really the time frame to use is going to be based on what's your objective. Are you going to go for a scalp or a swing, short, long, your time horizon, and etc. And really, when you get fixated on like one time frame, it gives you like a very limited view of the overall picture. Let's say if you're constantly stuck on the minute time frame, it might look good to actually enter a position, but then when you look at the hourly and daily, it's actually a garbage setup, and then you end up being in a losing trade. If you think about it, it really doesn't make sense to initiate a scalp using the daily chart, or doing a swing based on the minute charts. So in this slide, like, you really should be like scaling with all time frames, so that way you get a sense of what's going on with the story of the price. So personally, what I do is when I'm trying to define my objective in going to trade, not only do I use like the time frames, but as a rule of thumb, just remember about the 1 hour chart. Anything shorter than 1 hour, that's really geared towards scalps or intraday holds, sometimes maybe like an overnight. And then longer time frames like the 4 hour charts or the daily charts or even the weekly charts, that's geared towards swings. So but when you combine like all time frames together, you're able to find an ideal entry position, then an ideal exit. Oh, and then in practice, for me personally, let's say I'll do like an overnight hold. I'll look at the daily time frames to see like where the predominant price trend is. Then I'll start scaling down to the minutes so I could get an ideal entry. So here's one case study for IGC. So this was like in early April, where I initiated the alert like right around here, so around 50 cents. So when I was like going through charts, I saw this one because it was very attractive with the cup or possible cup and handle formation, and also keep in mind with the time frame. So remember that bullish patterns, they can last for like generally like a few weeks. So this one's from December to April, so that's about a span of 5 months. So you see the cup forming here, and then another cup forming again, and then a little one right here. So here's the break of the rims. That's why it was like a good confirmation to initiate a position right above here. And this is also based on the 4-hour chart. So with the overnight alert, the price did end up shooting to around 80 cents the next day. So on the day that it shot up, now you're evaluating whether or not to keep holding. So this could have been like a potential like multi-day hold. So by drawing like the trend line SARs right here, you'd want to see it break 80 cents because since it further justifies like to continue holding for longer, and then maybe see like if it'll hit $1. But now that it's just bouncing off this support, that's when you'll evaluate your position on whether or not to keep on holding. And this chart is on the 15-minute. So on the intraday, I alerted that around here on about 2 p.m. that it may be forming a possible head and shoulders. That's where I said to start reevaluating your positions or start scaling out or having like some sort of risk mitigation strategy. So, but then again, this head and shoulders also might be a pennant formation that's coming in. So in this case, it looks favorable on the daily chart, but as you're scaling in the minute charts, it starts looking questionable. So eventually, later on the day, it broke down, and it's confirmed like a head and shoulders pattern. And it retraced, by the end of the day, it nearly retraced back to 50 cents. So if you got in at that price, then you would have broken even if you kept on holding. it did start breaking below the rim, and this is the chart up to date. So for it to confirm another bullish trend, you'd want to see the price break above the rims again. So really, when you're looking at all the time frames, you have to think of it as like an engine to like a car. So on the outside it looks like it's working, but once you starts like the outside of the engine as like the daily chart, but once you start scaling in where you're going to the minutes charts, like you're gonna be able to see like how it connects, or if it makes sense to go in or leave a trade. So on the outside the engine might be working, but let's say a small part comes loose, in this case like the minute chart, it starts breaking down, then eventually the whole engine like breaks down. So it is like really imperative that you see like all the time frames and use your best judgment to evaluate on whether to take a trade or not. So here's another case study for just the 1 minute chart for PTIE. So in the chat you've always heard Frush say so many times that it is imperative to know the ticker's personality, because it really does in reality give you an edge. So let's say you didn't know the ticker personality for PTIE and you wanted to come in for a scalp. So 8 o'clock a.m. pre-market, and remember that chart patterns apply in all time frames, including both after hours and after including pre-market and after hours, given that there's enough volume to form a candlestick. So let's say you got in kind of late, so you're gonna take a position at market open, and it's now 10:30 a.m. and it's at VWAP. Are you gonna take a bullish position? Omanto, wait for a confirmation over VWAP. Yes, that actually would be the best case in this point, because for stocks like these, anything above the VWAP, of course, usually makes it more of a favorable long trade. But in this case, when you're looking at the pre-market and in market open pattern, it's really forming like a premature head and shoulders. Here's the neckline and the resistance points. Lieutenant, it looks like the volume is lacking though. Yes, but keep in mind that don't disregard any chart patterns just because of the lack of volume, because volume and price action always follow each other. So when you see tickers that have like a shoot up in price, there's going to be a surge in volume, so there's more buyers than there are sellers like stepping in, so that's what causes the price to drive up. But if there's more sellers than there are buyers, there's still a surge in volume, and then you'll see the price drop out even more. But in a sense, but when the volume like starts tapering off, that's like one of the clues that there's going to be a shift in trend or momentum. You just have to wait it out to confirm. Volume that's weeding off doesn't necessarily mean that the pattern is dead. It's usually more of like an indication for trend exhaustion, or like a temporary like reversion to the price. You have to remember, as a trader, you're going against other traders with different objectives. So eventually the price did not confirm over VWAP, and it ended up being a head and shoulders. So in terms of risk management, we noted earlier in the lecture that chart patterns don't lie. So they have about like a 75% accuracy rate on average. But remember, there's nothing is guaranteed in life, so that's why you'll see these little disclaimer tabs all over the place. So if they do have like a really high accuracy rate, like what happens or what should you do if you fall in the unfortunate 30% area? So here's one case study, MGT. So for those that are unfamiliar with MGT, one of the personality traits of it is that, for one, it's a cult stock. There was a lot of permabulls on Twitter and StockTwits, and it's a low float penny stock as well. And when it runs like fast and hard. So right about here is my entry, and the reason for the conviction for my entry is because it had like a bull flag right here, and at that time there was speculative PR going on, and then lo and behold, like shortly thereafter, McAfee tweeted that there was positive news on the Devasive acquisition plan, and their product Sentinel gets released shortly after. So I was getting excited, and then I see another bull flag or pennant that formed, and right about here is where the PR was. So I got excited even more, and I decided to keep on holding, and it gaps up the next day. So in this pattern, it's the 3 rising valleys. So it looks like a stair step pattern, where it's just basically a bull flag on top of a bull flag on top of a bull flag. However, at that time I did take in a large position. I forgot to like manage my risk. Unfortunately, on that day after the positive PR, the SEC halted the ticker, and due to like the violations of some sort, and it got sent to like OTC land. So there was like a huge drop in price. So yes, chart patterns have a high accuracy rate, but you have to remember there's just no way to like predict the future or to predict seeing if it's a bull trap or a bear trap. What ended up being nearly a $1,000 gain for me ended up being a $600-700 loss. In terms of risk management, you definitely don't want to trade against the trade. You always want to go along with it. Otherwise, it's just gonna destroy your account. And then predicting, that's really going to get you in trouble. So if you ever find yourself with this quote right here in your head, and you take a position based on this quote right here, you're probably gambling. It's really best not to like try to pick out where the top or the bottom is, because when you do that, you're really just fooling yourself. Because then what if you predict that this is the top, so you enter a short, but then it goes up even higher, so then you end up like biting your tongue and then getting squeezed out. Or if the price dropped so low that blinded by the fact that it has to bounce, but then it ends up dropping even more, having like a large loss. And you definitely don't want to enter a trade if you cannot identify the pattern or the trend. It's really just best to wait it out and observe until you can see like a clear picture. So do react accordingly. That also includes like being situationally aware of what's going on. Like any unexpected news or incurred events can make the price drop or can make it rally. And you definitely want to define what your objectives are and what your plan is. So when you're seeing a bullish pattern start to form in your head, like you're starting to come up with where or how you're going to enter. But at the same time, like a lot of people, especially with like new traders, they tend to forget like the exit part because they're so fixated on when or how to enter. In reality, it's equally important to have both like an exit plan and an entry plan, because if you do enter a trade and if you're too late to get out, then it ends up being like a break even or losing trade. Learn why you lost. Not all patterns will go as they get forecasted to, so they may prematurely break out or prematurely break down. So when you look at your trades, you're gonna see like why you failed to leave or why if you failed to enter, so that way in the future you know how to like react to it, which goes back to this process, really these two processes. So, and that concludes our like lecture series for chart patterns simplified.